Yeah, so welcome everyone to this fourth installment of our FinGeo series for this later part of the year. I'm Stefan Uma, University of Bayreuth, co-organizing this with Manuel Albers, University of Leuven. And I'm very, very happy to see you all, and especially our guest for today, Radha Upadhyaya. She's a senior fellow at the University of Nairobi. She's actually an economist by training, holding a PhD in economics from SOAS. She's also a chartered financial analyst. I'm mentioning this because it's a unique combination many of us financial geographers can't boast of. And she's also, even though she probably won't define herself as a financial geographer, working very closely on themes that are of interest to financial geographers. Today, she's presenting on employing capital and the role of patient capital in Kenya's manufacturing sector, with a specific focus on labor relations. And I would say this is also something many financial geographers have largely bypassed, both labor relations and manufacturing, even though some of the more pioneering work, Gordon Clark's work in financial geography, for instance, has started with labor relations and pension funds or patient capital. So it's really nice that we have you here, Radha, and you have about 30 minutes to present research you've been doing with Florence Daffé from the Technical University of Munich. This research is embedded in your broader interest in the political economy of finance, banking regulation, entrepreneurship, and firm innovation in East Africa, particularly Kenya. So welcome to our first FinGeo contribution from Kenya. And yeah, Radha, the floor is yours, 30 minutes, and then we have a Q&A afterwards. Thank you.
Thank you very much. Thank you. I hope you can all see me.
We don't hear you. Please unmute.
No, I could hear Radha.
Okay.
I'm not muted.
Yeah, no. It's good. It's good. Thank you. Sorry.
Okay. Okay. Good morning, good afternoon, good evening. Thank you very much to the FinGeo network for inviting me to present some of my research. As per the introduction, my name is Radha Upadhyaya. I'm a research fellow at the University of Nairobi, and the co-investigator on this project is Florence Daffé of the TUM School of Governance. She's actually on maternity leave at the moment. So yeah, doing some very patient labor on her behalf, but I think I can share my screen. Should I do that, or?
You can do it. I just thought you want me to share it, but you're welcome to do it. So.
So our research project begins with this key issue where, you know, the issue of generating employment and decent work in Africa. A recent African Economic Outlook report said that in the face of rapidly growing populations and heightened risk of social unrest or discontent, jobless growth is the most serious concern for African policymakers. So generating decent employment has now become a key social issue in Africa, but how to create more decent jobs? We show in this paper that the extant research is focused on state and businesses in shaping employment relations. And we focus on a third actor, which has largely been neglected in the discussion on the determinants of quantity and quality of jobs, and that's the role of finance capital. If we can summarize our results in one line, Our evidence suggests that access to more patient sources of capital, and we'll discuss a bit briefly about what we mean by more patient sources of capital, but we find evidence that access to more patient sources of capital enhances the quantity of jobs and quality of jobs. So that's the punchline. This presentation will follow kind of quite a general regular presentation style. I'll be very brief in the literature review because of time. Literature on employment relations in Africa has focused on two main actors, government and ILOs, and ILO and other NGOs in terms of their ability and willingness to pass regulations and the ability and willingness to monitor and enforce regulations. There's another literature on firms where firms have responded to high-level cases of harsh working conditions, which has led firms to often develop codes of conduct. And then the research has focused on conditions under which firms adopt voluntary standards and whether these standards have an impact on employment. Our literature shows that actually there's very, very little literature on the role of capital in employment relations in developing countries. When we look at the role of capital in developed countries, there are two main strands of literature that are there, the varieties of capitalism literature and the financialization literature. And again, I'll summarize this briefly. But both these literatures suggest that short-termism in finance may negatively affect employment and labor standards. I think most of the participants in this seminar in FinGeo are quite very conversant with the VOC literature in both the financialization literature, so I won't go into it in depth. But what we find useful from there is that there is evidence that patient capital, usually defined in terms of long-term funds, can provide more jobs and better working conditions. So we use this to build our theoretical framework. But what is patient capital? And why do we feel that this VOC and financialization literature is limited in the context of developing countries? We find it very limited because it's often, particularly the VOC literature, is based on this distinction between bank-based and market-based financial systems. And we feel that we need to look beyond this bank-market dichotomy, particularly when looking at developing countries, because they're usually mainly bank-based. And we feel that this literature does not try to focus on the varying levels of incentives of different financiers and how those incentives impact their ability and willingness to shape employment relations. Again, we've gone a bit more into detail in our paper, so I'll just go straight into our theoretical framework. So in terms of conceptualizing the role of patient capital on employment relations, we build on kind of work done a lot by Deegan Hardy, which really emphasizes that one of the main characteristics of patient capital is the length of maturity. So if the minimum requirement to be patient capital is it has to be long-term, which has got varying definitions in the literature, but between 3 and 5 years. Another characteristic which is in the literature is that an investor or a lender does not exit when a firm faces short-term issues. So the investor, the lender, whether it's an equity or a debt lender, exhibits some form of loyalty. The third characteristic of patient capital that we have defined, we have added more inductively from our research, is that an investor is willing to take on exchange rate risk. And we found this to be very important in the context of developing countries where exchange rates are very vulnerable and very prone to shocks. And whilst we give these as characteristics of patient capital, we do view patient capital as kind of a continuous variable, kind of with degrees of patience. We hypothesize, our framework hypothesizes three mechanisms which try link the level of patience of capital to quantity and quality of work. So we had proposed that access to more patient capital can directly help improvement in both the quantity and quality of labor if the incentives of the investors are aligned with looking beyond short-term profitability, and firms are responsive to the interests of their financiers. So that's a kind of a direct link that we've proposed. We've also proposed a direct link that we feel that patient capital would enhance the space for firms to pursue more long-term strategies, which may include the expansion of labor force and investment in skills. And we also propose that there's an indirect chain where access to patient capital indirectly impacts the quantity and quality of jobs, because firms may have more financial space through firm growth, and then that may give them more financial space. So that's kind of an indirect proposition we had in our theoretical framework. Our study was conducted in using qualitative interviews. We had 38 interviews in 2 rounds. Kind of COVID came right in the middle of some of our research. So we had 2 rounds in November, December 2019 and November 2020. And we interviewed a broad spectrum of financiers, including DFIs, PE funds, banks, and what's normally referred to as the demand side in kind of firm level literature, the manufacturing firms. We also interviewed other stakeholders. Going on to our findings, we just did a very simple kind of analysis of banks' balance sheet, because it was kind of very difficult to really know what is the level of patient capital. And what these 2 graphs tell you is, even though Kenya has a higher level of patience compared to availability of long-term capital compared to other African countries, overall it's not that high. And if you look at especially some quite large banks, you have like Standard Chartered Bank with over 80% in relatively short-term lending. So this was just kind of to almost give the context in more depth. We also tried to show that the landscape of patient capital is kind of different, quite different from other developed countries. And if we can come back to this in the question and answer if someone's more interested in this. So, we basically highlight the need to go beyond this bank market dichotomy. So what did we find? As we said, we interviewed a variety of partners, and we found that one of the key players in the Kenyan market are development finance institutions. And our interviews showed that DFIs have both the ability and willingness to improve the quantity and quality of employment. Their willingness rests on their mission to look beyond short-term profitability and achieve wider social goals. DFIs have regular reporting mechanisms to monitor the extent to which firms which they are providing funding have expanded the workforce or improved labor standards, especially in areas DFIs deem deficient. Their ability to improve labor relations originates from the pressures that firms seeking to continue receiving long-term DFI financing feel to be responsive to DFI pressures. Breach of contractual obligations if a firm fails to address DFI's labor concerns. One of our interviews said, given the importance of DFIs in the market, it is pretty rare that people take the risk, explains a senior DFI official. With DFIs providing potentially up to a third of financing needs in this market. We also looked at private equity firms, which have really become quite, developed a lot in Kenya in the last 15 years. And we found that overall, they have both the willingness and ability to improve the quality of employment. This is an area where I think there's this stark difference between developed countries and developing countries, where in developed countries, PE funds are basically considered kind of very short-term, impatient capital. But their willingness rests on their mission to look beyond short-term profitability. But this is mainly because the majority of PE funding available in developing countries is from DFIs. And their ability to improve labor relations stems from the pressures that firms seeking to continue receiving long-term PE investment feel. The effect on quantity of employment is a lot more ambiguous. On one hand, PE firms may encourage an expansion of employment as part of their strategy to enhance firm growth and by providing a financial base to expand staff numbers. And I feel that's, a cursory look. We didn't look at service firms in Kenya in this we mainly focused on manufacturing firms, but you can almost see it like, lots of Javas coming up all over Nairobi due to PE funding. The impact on manufacturing employment is very ambiguous. Yeah. So whilst there's a push for growth and expansion, there's also a push for efficiency. So as one of our interviews with the firm manager said, so headcounts are going down. I think, again, it's a difference between a family-owned company where you are running a marathon versus a private equity co-owned space. It's definitely not patient in any sense of the word. Private equity rarely looks at your past performance, and it's always looking at your future performance. So even if somebody has been a superstar employee in the past, if they can't contribute to the future, that person has very little value. So to summarize, PE funds in Kenya have improved and do have the ability and willingness to improve the quality of employment because of this reporting that goes back to their DFIs, who are their main investors. But the data on quantity of employment is very ambiguous because of the short-term nature of kind of a PE fund cycle. We also interviewed banks, and we found that largely they're concerned with short-term credit worthiness of their client firms. So there are few incentives to improve the quantity and quality of employment. And it is only through public interventions, for example, a line of credit from DFI or Central Bank of Kenya pressure to be more patient, that forced banks to be more patient. So the COVID situation, became a sort of lens for us to view this, because when COVID hit, the Central Bank of Kenya immediately suggested to banks to become more patient in their lending and to restructure loans. And one of our interviews said, because there was a period literally where we were not selling anything and we just had to keep going. And basically our own bank financing mechanism helped us to continue without having to reduce jobs. Banks have also or continue to receive a lot of lending from DFIs. So DFIs fulfill their kind of long-term lending function through big investments. But DFIs, in terms of trying to influence lending to SMEs, where they don't have the capacity to do that sort of lending, the whole kind of idea or has been to give loans to banks to then onward lend. Now there's evidence of a lot of activity, but it's not clear what the total level is. Almost like every couple of weeks, I'll see an article in the newspaper saying KCB gets a loan from IFC. Yeah. From our interviews, we found that when there's onward lending of a DFI loan, there's evidence of increased maturity. So that fulfills our first criteria of patience. There's also evidence for requirement to collect data on employment trends, but there was no requirement for compliance with labor standards. So what are our conclusions in the paper? The evidence in our paper suggests that access to more patient sources of capital may help enhance the quantity and quality of jobs in African countries. We find evidence for our first mechanism where directly patient capital providers care about social performance, which leads to whether PE funds or manufacturing firms they've invested in actually improving their labor standards. And we also find evidence for the second mechanism that we proposed, where patient capital providers enlarge the space to provide more long-term strategies, more breathing room, which allows for improvement in quantity and quality of jobs. We find little evidence, or just some evidence, it's mixed, for the indirect link we had proposed of firm growth leading to improvement in quantity and quality of labor. So we feel our findings speak to an emerging literature that argues that capital needs to play a greater role in this new social contract if we're to enhance social cohesion. For example, Meager 2018 has argued that the conceptions of a new social contract tend to focus only on the didactic contract between citizens and state, and the role of capital has been largely airbrushed out of this discussion. We feel that this is like an initial contribution to trying to include the role of capital in the debates on the new social contract. So our contribution in this paper is we provide a conceptualization of patient capital in the African context. We show that it's necessary to move beyond the bank capital markets dichotomy. And we show the importance of sharing exchange rate risk as part of the conceptualization of patient finance. Empirically, we show that there are differences between various market actors, and we show evidence of the mechanisms of the change linking patients to employment relations. We have a few policy suggestions, and so our findings in our paper suggest that patience is not exogenous, but that the degree of patience can be manipulated, which allows for room to bring finance capital back into the new social contract. We would particularly argue for the need for transparency in data on DFIs and PE funding. There was, I just assumed when I started this that there would be some web page or that would have all the DFI lending to firms in Kenya and, DFI lines of credit to banks and DFI lending to PE funds, but it's not there. And we would encourage for DFIs to increase monitoring of all investments. There is evidence that they monitor in debt and equity, which has led to improvement in quality of jobs, but also in credit lines to banks where there's no evidence of monitoring. We argue for a need for long-term financing in local currency and the sharing of exchange rate data. We found very little evidence even of DFI funding in local currency. And we feel that the regulator may be able to have more nuanced use of liquidity ratios to encourage banks to lend long-term and also encourage data collection on employment trends by banks. So this is part of our research is currently in a working paper here, and we're hoping to use some of these seminars to develop our journal articles. So thank you very much.
Thank
Stephen,
you. Yes.
Should I leave the slides on, or can I stop the sharing during the discussion?
I think you can stop it, and if the need occurs to shift back to one of them, we can do so. But
Okay.
gives you more exposure, so this is good. Thank you, Radha, for this very interesting presentation. And I already see that we have a number of questions, and we have a lot of time for that because your timekeeping was excellent. Thank you. So I have Darek, the first one, to put a question in the chat. Maybe you can verbalize those again, please, Darek.
Thank you very much, Stefan, and thank you, Radha. Very nice to see you. Very interesting presentation, not least because it's related to many other concepts and developments in this area of financial research and economic research and financial geography. So I have several questions, but I will ask them very briefly. One is, how do you relate your use of the concept of patient capital to ESG, environmental, social governance indicators or ratings? A lot of what you talked about could be related to S in ESG. Then it leads me to the second question: how do you relate your concept? How do you position it in relation to sustainable finance? The idea of sustainable finance, because again, a lot of what you say could be put under that umbrella. I mean, we just had COP26 ending, successfully or not, depending on your perspective. But so it's good to ask these broader questions here in relation to patient capital. Then another kind of semi-empirical, semi-conceptual question is, I was wondering, also in the context of Kenya, would be interesting to hear, but in the context of Africa and globally, what your thoughts are on Islamic finance and its principles in relation to patient capital. Because, for example, when you say about risk sharing, it sounds like one of the principles of Islamic finance. So I was wondering whether Islamic finance in any way relates to or informs your thinking on the topic. And then only two more questions. So one is about the nature of your evidence. So I was curious whether this is a survey based on declarations of these respondents, or whether, how skeptical should you be or we be about what they declare in relation to what they do. So to what extent is it actual revealed performance and behavior rather than just intentions or self-perceptions? And really final question. So what you said about liquidity ratios, I was just curious how you would use those to study patient capital. No need to answer all questions, but I wanted to put them out. Thank you.
Thank you, Darek.
can I go ahead or?
Yes, you are invited to respond, and as he said, you're invited to choose as well, because there were many questions.
So the broader questions on how do you relate patient finance to ESG, actually, when we went into, sorry, maybe I'll answer the second last question first. It was not a survey, it was in-depth qualitative interviews with a range of actors, including of our 38, I think we had 10 or 12 firms, I can't remember exactly, where the number of employees was a big range of the number of employees. We did not ask like very like questions that would like in a way maybe make them want to hide things. It was very much like the process of improving labor relations once they got funding, or you know, so that is what revealed. I don't feel you know, whilst because of the nature of qualitative interviews and, you know, having 38 interviews means that we, you know, we can't generalize in like you would with the broad survey, but we don't feel that there was any kind of likelihood of people wanting to hide anything, because the questions weren't putting people on a spot. So in terms of the ESG and sustainable finance, I must say I was a bit of a skeptic. So I expected there to be more emphasis by the DFIs or by the lenders on the E and the G, on the environmental and the governance, and not the social. So I actually was surprised how much the social was actually emphasized by particularly DFIs in terms of who they lent to. And also how much it was monitored. I actually found that surprising. And we had evidence, particularly after COVID hit, of how DFIs helped their firms to put in a lot of protective equipment to, you know, protect the staff, a lot of, you know, and not only be a bit more patient in terms of the actual debt, but in terms of helping the employees. In terms of sustainable finance, I'm not 100% sure about the question, but I do feel that there's this contradiction even in Kenya, because the move very much is towards kind of digital short-term finance as the future. And yet I feel that resolving things like the climate crisis needs long-term patient finance. So I feel that maybe this paper can be linked to sustainable finance that way, that we just simply can't rely on fintechs or digital credit to resolve these broader climate change issues. I'm not sure I've answered the question completely. I'll also leave out the question on Islamic finance for now, because I'm not, I think, yeah. Yes, risk sharing is there. Kenya is actually, sorry, let me just answer it. Kenya is actually one of the few African countries. It was almost like when M-Pesa was allowed, it was this view that, you know, let's make Kenya, it's part of Kenya's broader strategy on becoming a financial hub. So all the regulations were brought in to allow Islamic banking. What's not clear to me is whether, because I don't see that in kind of the lending ratios or of the few Islamic banks that I'd studied some time ago, whether that really has led to more long-term capital. And in some cases, we've had issues like Charterhouse Bank, which closed, where Islamic banking was used to kind of disguise excessive investment in property. So I think the issue of Islamic banking, at least, yeah, theoretically is patient capital, but when it's applied in specific contexts, maybe it's not bringing out the gains. And particularly, I haven't really seen much Islamic finance used for manufacturing. It's very much used for real estate, where you know what the property is. It's not a mortgage, but you co-own it, so the bank is not worried. You know, it's not, the bank's not taking any level of risk on a firm, or yeah. In terms of liquidity ratios, the idea is banks in Kenya have if you actually look at the actual balance sheet, most of their deposits are short term. So if you tell a bank, they're like, we can't lend long term, our deposits are so short term. But actually there's a large chunk of that deposits that just stays with the bank for like 20 years. It's like it's a savings account, but it's there, or it's a 3-month deposit that's continually renewed. So I think with technology, I think there can be a more nuanced way to understand what is actual short-term deposits and what is actually short-term on paper, but actually just stays with the bank. And that, I think, may allow banks to lend a bit more long-term.
Thank you, Radha. There's another question by Isaac Mongale. Could you please come forward? Isaac?
Hear me?
Yes.
Actually, I'm very sorry I'm unable to share my video for now, but my question was centered on the recent development by the President of Kenya, that is Uhuru Kenyatta, when in his Mashujaa Day speech, he made a declaration that there were defaulters of the CRB, that is the Credit Reference Bureau, who are to be delisted from that list. And what I've gathered is that there are some mixed reactions towards the president's directive, and one of them was from the central bank governor, who is Dr. Patrick Njoroge. I don't know, how does that affect lending in respect to what we are discussing right now? Because it is an interesting topic, more especially when we look at liquidity, when you look at lending, and especially in the context of the developing nations, Kenya being an example.
Thank you. Radha, I think you can respond.
I actually firmly agree with the central bank governor, Patrick Njoroge. I think when COVID hit, because of I do not feel the CRBs are perfect, or especially when it comes to like digital credit fit for purpose. So in other work I've done on digital credit, I was actually calling for a moratorium on defaulters who've been listed in the CRB, but those defaulters are less than 1,000 shillings. What I think this will simply do, this directive by the president or by Treasury, and I completely agree with Dr. Patrick Njoroge's view, is banks will just stop lending. They will only lend to people who they have an eye on, or who they can lend on their salary slip or something like that. Because if all defaulters below 5 million shillings, that, the average deposit size in Kenya is very low. So 5 million lending is very low. So 5 million shilling deposit is considered quite high. I think it'll just make it'll kill the Credit Reference Bureau system that was kind of put in 2005, and is really been a long process to try get it to work. It doesn't work mainly because a lot of positive information is not shared. But if everyone who's defaulting below 5 million, it'll basically kill the credit market, and banks will just do what banks in Kenya have been quite happy doing, which is to lend to government treasury bills. I think, I feel it's more a populist move rather than the move that will actually help the banking sector and will increase credit in Kenya.
Thank you. Any more questions?
Stefan, you had a question?
Yes, I also had a question. But if anyone wants to come forward, we can pick that person first. Yes. Oh, okay. Yeah, my question would relate to what some scholars have called the Wall Street consensus. Daniela Gabor is the one who coined this phrase, but several others have written about that, Emma Morsley, for instance, and they are more critical relating to the new social contract and the role that capital should play in this. And one of their concerns is that the increasing call on states to de-risk finance or financial investments shifts a lot of responsibility to states, privatizing the gains but socializing the risk. And the second is that the call also comes along with a call to implement more market-based financial systems so that large investors can incorporate these systems more easily into their portfolios. So backed up by your situated view and your research, what would you respond to these more critical voices that even warn of a type of Wall Street consensus? Because you ended with a rather positive note on the role of finance in society more generally. Yeah. Thank you.
So again, it's hard to answer this question without referring to other research I'm working on. So what I'd like to say is, I think this paper shows that patient capital has the ability and willingness to improve labor conditions. What this paper is not saying is there is a high level of patient capital in Kenya. Yeah. And the questions of how to increase the level of patience is something that I think still really needs to be discussed. In terms of the financialization critique, I think the evidence in Kenya very much comes from other research that I've been doing with Karen Weitzberg of UCL and Linda Bonio of the Lawyers Hub, which focuses on the digital credit. And there is clear evidence that there's increasing there's evidence of over-indebtedness among borrowers, and this kind of lacuna in regulation of digital credit has meant that kind of even more positive people who thought digital credit was kind of a tool to financial inclusion in our interviews see it as a form of financialization. But in terms of some of the in this, they actually, there is not that much state de-risking of finance. There's been a discussion for a long time for us to kind of have a state-run development bank. Those discussions keep continuing. So I don't see the evidence for the state actually de-risking a lot of this finance. It's kind of, the state has provided quite an open regulatory structure so that these things happen, but the evidence of kind of the negative consequences of financialization that I see in the Kenyan market are very much at the very micro digital instant loans. They're not with this long-term patient capital. Yeah.
Thank you, Radha. There's more. Derek, again, is there anyone else who wants to pose a question before we return to Derek's very interesting question? Any of our African colleagues? Martin. Sorry, Derek, I have to put you on.
Yeah, sorry, Derek. Hi, and thank you for the interesting presentation. I just want to go into another one, which is the SMEs, and which you studied, and whether it matters where they are located in global value chains or what they actually do, because it can really make an impact on what access they have to various financial sources. At least from my Eastern European perspective, for example, companies which are, multinational companies, and they have better access to better financial sources, and perhaps other smaller companies in lower tiers of global value chains, they don't have access simply to patient capital and only to these short-term bank credits, which also goes back to the worse employment conditions, how you put it. So my question is related to the SMEs you studied. Thanks.
Okay, so it was very difficult for us to really discuss the global value chains. The majority of our firms, manufacturing firms, had some level of exports, but they were really mainly catering to the Kenyan market. We did not interview any firms in like the export processing zones. Where the role of MNCs came in, and again, it was evidence from only 2 firms, is that in terms of employment relations, because a lot of MNCs are also, because of their own reporting, so firms that are supplying to MNCs have another pressure of improving labor standards because of the standards of the MNCs that they've had to adopt because of all the research that had come out about the adverse working conditions. So that pressure, so some of the firms that supply to MNCs kind of reflected that they were more ready to comply with some of the DFI regulations because they'd already got some of those regulations, particularly when it came to like maternity leave, things like that. They already had those conditions from their MNCs. But that evidence is not like something that I feel was across the board, because not all the firms we interviewed were, we were trying to get a range in terms of employment size. So this issue of value chains did not really come up that much.
Thank you. Let's return to Darek's question. The famous fintechs of Kenya, many of which are non-Kenyan, let's put it that way. What role do they play as providers of patient capital, if they do it all?
Yeah, and can they help it, even if they don't provide it directly? And if not, why do you think not? If yes, maybe you can tell us about it.
So, there's a broad range of fintechs in Kenya, and I must say that I don't have a grasp on all of them. The fintechs that I have researched in detail are fintechs that are purely doing digital lending. So that's my main research area. I believe fintechs themselves as a source of capital have been getting long-term capital, and that partly relates to Stefan's question of venture capital. I personally do not think there are any venture capital firms here yet. Even PE funds in Kenya, they invest in family businesses that have proved themselves for 20, 30 years to take them to kind of the next level. They're not taking the risk on startups. Whilst the startup, and this next statement is very much just a cursory look rather than any research I've done, while the startup landscape in Kenya is very active, it's mainly funded by outside funding. So again, I've not really seen, I've not researched that area, so I can't say. But the fintechs that focus on digital lending, by their nature, are very, very short term. So the kind of policy drive by both the Kenyan government and donor bodies to kind of assume that digital credit, short-term credit, will be the answer to our SME, to lending to SMEs, I think is kind of a false faith. whilst Kenya is a financial inclusion darling, and we've really, increased access to finance, particularly through payments, through M-Pesa, and there's evidence to show that M-Pesa has helped poor people manage their risks better, but the evidence on digital credit is very mixed. And I think my research, which I'm still writing up, so but there is evidence of over-indebtedness, and partly because that space was allowed to come up without any regulation.
Thank you, Radha. I've also copied a recent research piece by Kevin Donovan and Emma Park, which raises these points. Are there more comments, questions? Don't be shy. We've grown to 34 people, so towards the end, we are getting more and more people. So good for us. More people can ask more questions. So anyone? Karen says thank you. I thought you would like to ask a question because you're also a fintech researcher. Maybe you have a good one, Karen.
No, I'm just enjoying learning from a part of the literature and a part of the world I don't know very much about. So thank you very much, Radha. Yeah.
Great. Thanks for the feedback. I see Shaila or Sheila. Sorry, I don't know how to pronounce the name. Maybe you can help us. You have a question.
No, this is actually Sita Shah, using a different name.
Okay.
I just had a comment. It's not a question, but I work with FSD Kenya in their housing program. And one of the pillars that we have come to for our housing program is called open access. And I was really interested to hear the lack of transparency that's been brought out in this presentation by investments made by DFIs. So it really speaks to the same conclusion that if we want to make an impact as a community, we should have broader sharing of data, what the impact was, who the players were, and shared with the markets. I would really, really relate to that particular conclusion. We see so many failed housing investments, and we don't know why they failed. If the DFIs came and said, this was what happened, this is actually how many housing units we got, it would really add to the work and the risk taking. Thank you.
Thanks a lot for that comment. Something we frequently encounter as researchers on financial topics, the lack of data, or at least the lack of accessible or affordable data. So any more remarks, comments?
Hello?
Yes, please.
Could I just make a comment? It's not a question.
Mm-hmm.
Yeah, my name is Moses Bosire, and I'm so much interested in industry. I'm currently based in the UK, and I've actually worked in the manufacturing sector in Nairobi. So this was quite interesting to see someone actually studying why the manufacturing is not really taking that growth from the financing. So as I said, really interesting research, and I'll be following it up through and through. Thank you.
Thank you.
Thank you. It's lovely to have this kind of feedback and the new connections emerging via COVID, unfortunately, but yeah. We have 5 minutes left. Anyone? I would have another one as a moderator. Rather domestic pension funds. My experience with NSSF from Tanzania, which is a kind of social security fund, but they operate a little bit similar to pension funds. They like to go to real estate and these kind of more or less unrisky. I mean, real estate is risky, but it seems like a clear thing in a way or another. But production has been largely bypassed by pension funds. At least that is always the story we've been hearing when it comes to different parts of Africa. Have you encountered a shift in pension fund behavior, domestic pension funds, when it comes to offering patient capital solutions to manufacturing sector enterprises?
I think there is a discussion, but I think it's very, very slow. So there's basically no direct investment by pension funds. Now, pension funds is obviously probably the most easy source of domestic long-term capital. I know the RBA has changed their regulations to allow pension funds to invest. I can't remember whether it was like maybe 5 or 10% of their portfolio in what they call alternative assets, like private equity funds. But I have not really seen the evidence of how much they've done that. And to be honest with you, I'm not necessarily you know, it kind of, I think the level of skills that pension funds would need to really understand the PE funds they're investing in, I think there's quite a long way for that to happen. And the returns relatively on property and government treasury bills are relatively quite high to then just whether you then justify actually taking that leap and investing in manufacturing. You know, it's yeah. I don't some very early research I'd done like in 2005 was very much just a summary of kind of 10 years of the banking sector in Kenya, and it was, you know, very much showing, oh, financial inclusion gone up, lots of good positive stories. But if you look at the lending portfolios of banks, whilst the total credit has gone up, the proportion of lending to both agriculture and manufacturing has gone down. Now, we don't have that sort of data overall at a national level if you included like DFI funding and private equity funding and things like that. But even when you look at DFI portfolios, just a cursory look of CDC or, you know, the proportion that's in manufacturing is quite little as a total of their proportion.
Yeah. Okay, great, Radha. We close here. We say asante for this presentation. You helped us to get a really big crowd, so 35 people is really good. And I think we all learned a lot, and we're eager to read more about this research and your other research that you've been mentioning. The digital lending stuff sounds very interesting, but you also did really interesting work on banking regulation, the political economy of banking regulation in East Africa. So thanks again, and in 2 weeks, Manuel has already posted this. We'll meet again, Governing Urban Displacements in Global Capitalism with Susan Söderberg. So this is going to be interesting as well. And yeah, happy to see you again.
Thank you very much, Stefan. It's a really honor to be part of this seminar series. So thank you so much.
Bye-bye. Thank you.
Many thanks, Radha. And also thanks for everyone asking questions, and hope to see everyone again in 2 weeks. Bye-bye.